In this video, we are going to talk about protected swings, which are also called protected highs and lows. Many traders get stopped out, and then the market moves in their direction. That happens because you don't know which high or low will stay protected with your stop loss. Let's get straight into it. So now let's talk about protected swings, because this is a very important concept. A protected swing is simply a high or a low that I expect to hold if the trend is going to continue. In other words, it's a level that price should respect if the current direction remains valid. For example, in a bullish scenario, I expect a certain low to remain intact if price is going to continue moving higher. If that low fails, then the bullish idea starts to weaken. Now the question is, how do we actually define a protected high or a protected low? There are two main ways this can happen. The first type is based on a liquidity sweep. If we are bullish, what I want to see is a short-term low, get run, or swept. After that sweep happens, I look for price to close above the series of down-closed candles that created that low. So in this example, here is the low. I then identify the group of down-closed candles that formed that low and mark that level out. Once price closes above that level, that low becomes a protected low, and I now expect it to hold if price is going to continue higher. Now, when do we not need to sweep the low directly? That happens when we are using SMT. In this case, the correlated asset runs the low, while the main chart does not. Because the correlated market has already taken the liquidity, we can still treat this low as protected. In that situation, I again identify the series of down-closed candles that form the failure swing. Once price closes above that level, I can anticipate that this low will hold as price continues higher. The second type of protected swing comes from a fair value gap. In the first two cases, the protected swing is created after a high or low is swept. In this case, price does not need to sweep a low. Instead, price trades into a fair value gap. When price reaches into a fair value gap, I then locate the low formed inside that area. From there, I identify the series of down-closed candles that created that low. Once price closes above those candles, that low becomes protected, and I expect it to hold if price is going to continue higher. Now let's look at this in context. Here you can see price trending down into an important level where we might expect a shift in price behavior. You can see a series of down-closed candles forming into that level. At first, price does not close above those down-closed candles, which means the market is still bearish. Then price comes in and sweeps a short-term low, taking liquidity. After that sweep, we identify the low, mark the series of down-closed candles that formed it, and wait. Once price closes above that level, that low is now protected. At that point, we can anticipate that price is likely to reverse or transition into a new bullish phase and continue higher. From there, we can start looking for entries or continuation setups, because we now have a protected low supporting the idea that the trend is shifting. Now let's jump into TradingView and look at a few real examples so you can see how protected swings form and how to use them in live market conditions. All right, so let's take a look at this example and go through it carefully, step by step. The very first thing we are always going to do is wait for an important level to get swept. So the question we ask is, what are the important levels here? In this case, the important levels are this high and this low. So we go ahead and mark these levels out. The high is going to be our buy-side liquidity, and the low is going to be our sell-side liquidity. Once those liquidity levels are marked, we don't jump into a trade. We simply wait and let price decide which side it wants to take. As price moves forward, we're watching closely to see if either the high or the low gets swept. And yes, in this case, we do get a sweep. Price comes up and sweeps the high, which means buy-side liquidity has been taken. At the same time, if you look closely at the higher time frame, you'll notice that we also have a two-candle pattern forming right here on the hourly time frame. So now we have multiple things lining up: a buy-side liquidity sweep and a valid candle pattern. Now that we've identified this setup on the hourly time frame, the next step is to drop down to a lower time frame for confirmation and execution. In this case, we move down to the 1-minute time frame. Once we're on the 1-minute chart, what are we looking for? We're looking for bearish confirmation, because after a buy-side liquidity sweep, we're expecting price to move lower. More specifically, we want to see bearish candles closing below a series of consecutive bullish candles. So first, we identify which candles are the consecutive bullish candles. These candles right here are the consecutive bullish candles we're focusing on. Now we wait. At this point, we do not yet have a bearish candle closing below the opening of those bullish candles, so we stay patient and let price continue to develop. Moving forward, price finally gives us what we're looking for. We now get a bearish close below those consecutive bullish candles. This right here is the price signature that tells us the high that was just swept is now a protected high. In other words, price is unlikely to return back to that high unless it first goes and collects opposing liquidity. So now we ask the next question. What is the opposing liquidity? The opposing liquidity is all of these lows below price. These are the sell-side liquidity levels that price is now attracted to. With that understanding, we can now execute the trade. We enter on this change in the state of delivery, we place our stop loss above the high, and we target these lows resting below. And as you can see, price moves very cleanly and very easily into our targets. This example shows exactly how waiting for the sweep, confirming the protected high, and then aligning with opposing liquidity allows you to trade with clarity instead of guessing. All right, now let's look at this example because this one really helps you understand how context works in price. In this case, price has already swept the low, which is the sell-side liquidity we were targeting from the high. This immediately gives us important information about what price is trying to do. Since we have a sell-side liquidity sweep, the next thing we need to check is the hourly candle close. We want to see whether the hourly candle closes inside the low that was swept. And in this example, yes. The hourly candle does close back inside that low. Just to remind you, the same rule applied in the previous example as well. When the high was swept, we made sure that the candle closed inside the high sweep, and it did. That candle close is very important because it confirms that the sweep was valid and not a continuation through the level. Now, focusing back on this example, what do we have on the hourly time frame? We clearly have a sell-side liquidity sweep. Once that context is established on the higher time frame, we move down to a lower time frame for execution. In this case, I prefer using the 1-minute time frame, but you can use whatever lower time frame you're comfortable with. The concept stays the same. On the 1-minute chart, we now look for confirmation that price is shifting. If you look here, this was the last bearish candle, and in this situation, it's just a single bearish candle. Price then closes above that bearish candle. That close is important. When price closes above that bearish candle, it gives us confirmation. We can now look for an entry at the order block that formed from that move. At the same time, because price has closed above that bearish candle after sweeping sell-side liquidity, this tells us that the low we swept is now a protected low. Price should not come back below that low unless it goes and collects opposing liquidity first. So now we execute the trade. We enter from the order block, place our stop loss below the protected low, and then look at our targets. Since price has already swept sell-side liquidity and we are aligned with a higher time frame bullish narrative, price is expected to move higher and eventually make a new higher high. Because of that, we can use these highs above price as our targets. And as you can see, price moves very cleanly and very directly into those targets and hits them. This example clearly shows how liquidity, candle closes, and protected lows work together to give you clear direction and clean trade execution without guessing. All right, guys, so this is how you're going to find protected highs and protected lows in the market. The whole point of this video was to help you understand protected swing points and how price behaves around them. You're not randomly guessing where price will reverse or continue. You're letting liquidity get swept, waiting for the candle close, and then identifying which high or low is now protected. Once you understand that, everything else becomes much clearer. You know when a level is likely to hold, you know when price needs opposing liquidity, and you know where to focus your attention instead of chasing moves. So remember, this video is all about protected swing points, how to identify them, how to confirm them, and how to trade around them properly. If this video helped you, make sure to like the video and subscribe for more ICT-based breakdowns like this. Links to my Telegram, Discord, mentorship, and funded account discounts are all in the description. Trade safe, manage your risk, and I'll see you guys in the next one.